Hello everyone and welcome back to this exciting lecture on risk management. So in this lecture we are going to learn about what is risk management, what are the types of risks and what is the risk life cycle. Also we will be going through the risk description. Okay, so this is going to be one of the core concept in GRC. So I will request you, if you haven't watched the previous two video on GRC, please go and watch. The link is in my channel. So let's start this video. What is risk? Risk is anything that has a negative impact on organization. The risk can be considered as an event or an action that will lead to some negative impact on organization's business objective. So risk consists of three things, that is threat, vulnerability and impact. So how you answer this question? What is threat, what is vulnerability and what is impact? You can answer this by asking yourself these three questions. That what can go wrong? That is a threat. Then why can it happen? That is a vulnerability. Then how bad will it be impact? That is an impact. So how bad will it be? So suppose your system has been compromised by a hacker. So now hacker is a threat. Now your system has been compromised. Your system is the asset and it has been compromised, so it has become a vulnerability now. And how bad will it be impact depends upon the blast radius. Suppose your laptop is connected with your company's internal network and it has been compromised, and your malware has been spread from your company laptop to your company's network. Then multiple systems that are in that particular network had a chance of getting compromised. So the blast radius increases. That is the impact. So now let's understand what is risk management. Okay, before going to the risk management part, we will be looking forward to what are the types of risks. So as an information security role, there are 6 to 7 kind of risks. Mainly they are like operational risks. Operational risks are something that came from maybe internal process, people or system. Like it can be server downtime, system bugs, lack of security awareness. This comes under operational risks. Strategic risks are like risks that can affect long-term business goals, like poor security strategy leading to loss of enterprise clients. Then we have legal and compliance risks. Suppose your company doesn't abide it with the legal and statutory compliance, then it can be fined or it can be charged during an audit. Suppose your company is having a risk of violating law or regulation like ISO 27001 or maybe RBI guidelines or GDPR or HIPAA or any kind of things. Those things will come under legal and compliance risks. Then reputational risks. Reputational risk is something that makes a loss of customer or market trust. Say public data breach happen in your organization that has impacted your brand value, your company brand. So it created a negative media or user review. So that is a reputational risk on your reputation. Then we have information or cybersecurity risks. These are the risks associated with the assets, like if they are compromised with the virus, malware, or any kind of attack. Then we have third party risks. So risks associated with the vendors or the third party. So an organization, it mainly work with your staffs, but for you have dependency on various things to work with. So suppose you have a company. In a company you have a server. So server is mainly, let's say, about X brand. So you have a dependency of X brand with your company. So that is a third party risk. Okay. Now let's understand what is risk management plan. So risk management plan outlines the major threat facing your technology or operations and define the proactive strategy used to mitigate those risks. Now, mitigating a risk, that is a new term. Now we will be looking into what are the risk action, in which we will say what can be done. Suppose there is a risk, how you will handle it. So there are stages in a risk. We will be looking at that a risk management life cycle. So in GRC role, we don't eliminate risks, we just manage it. Okay. Suppose there is a risk and it is been there for long and you have applied some controls to reduce those risks. Okay, but the risk is still there. So risk can never be fully eliminated. It usually get expired or it maybe get reduced. So the stages of risk management includes risk identification. So what is risk? Okay. Then why that risk came? That analyzing and assessing the risk. Then risk treatment plan. So we will be looking more into this. Then at last stage is monitor and review the risks. So let's understand what is risk description. So risk description consists of four things. First one is asset, second is threat, third is vulnerability, and fourth is impact. So any risk description must contain these four things. Asset is the thing which is getting impacted. Suppose attack happened to your system, then your system become your asset. Then threat, who caused the risk? So hacker in this case caused the risk. Vulnerability, what caused the risk? Maybe your system is not up to date. Patches are not being deployed. So that is a vulnerability. Then impact, what is the business loss? That is an impact. Let's understand with the following example. Due to weak access control mechanism on the customer database, there is a risk that unauthorized user may gain access resulting in data breach, regulatory non-compliance and reputational damage. So now in this given statement, it covered all the four aspects. So here, what is the asset? The asset is what is getting impacted, that is customer database. Then we have threat. What is threat? Unauthorized access, that is a threat. What is the vulnerability? Why it happened? That is a weak access control mechanism. That is a vulnerability. And impact, what will be the impact? Regulatory fine, data loss, or brand damage. So these are the four key aspects of a risk description. Okay. Other thing that you may know about risks are the likelihood, how likely it is to happen. It is based upon the past experience or past possibility or probability like an event has been occurred. So in this case, likelihood is measured as low, medium, high. Okay, so suppose for this scenario it is medium. Okay, then existing controls. What are the controls that are there to avoid this particular risk to occur? So this contain password policy, basic logging, etc. Maybe uh, you have authenticator in place. So these are the existing control that helps in protecting your environment so that this risk never happen. Then risk rating, it can be considered again as high, medium, low. Okay, so it is as high because the impact is high. So now the risk owner, who is owning the risk? So the information security manager is owning this risk. Okay, then the treatment. So what if this happen, what you will do, or maybe what are the steps you have thought of doing it, like implementing multiple factor authentication and access. So this, by this you can reduce this risk. Now moving forward, we will uh, see what are the risk action plan. So for a risk action plan, what are the things you can do when a risk had occurred? Suppose a risk has occurred. Now what else you can do? So these are like mitigate, accept, transfer, avoid. Either you can mitigate the risk. Mitigate is means that there is a risk, but you are taking some control so that the risk is getting reduced. The impact is getting reduced. Acceptance is that you accepted the risk. There is a risk. You have done everything what you can do, but there is still a risk, and you have accepted it. That nothing can be done. That is accepted. Then transfer. So you transfer a risk. and then avoid. You just avoid it. So this was the layman description of all these four terms. Let's say mitigate this. Take action to reduce likelihood or impact by implementing controls. So you implement some controls and then you mitigate those risks. Suppose here, let's take an example that unauthorized access to customer data due to weak authentication. So this is the risk. Now what you do, you implemented multi-factor authentication. So you mitigated the risk. Then risk acceptance. Suppose there is a minor downtime of an internal training portal. So there is a minor downtime is there. So you did nothing. You just accepted it. So since there was a minor downtime, it doesn't impact it much. So you just accepted it. Okay. So that is risk acceptation. Then risk transfer. So suppose you are buying a health insurance. So what you are doing? Suppose in future you met with an accident, so that withdraw huge amount of money from your account, like medical expenses or something. So what you do, you take a policy, healthcare policy or a healthcare assurance you taken from a third party. So what you did it, you are paying some EMI, and in return that third party insurance company is paying for your hospital bills. So you are transferring your risks of having accident. Having accident is still there, but the expenses that will occur, you are transferring those expenses to the third party. So that is risk transfer. Then avoid. So you just avoid that risk. That certain thing is there. So in which scenario you avoid the risk, in which scenario you accept the risk. Suppose the risks which will cause very less harm to your organization, you accept those risks. Suppose there is a risk which cause high impact. The impact is very much high. You just avoid those kind of risks. It's better to avoid those risks. So I hope these 4 points are clear to everyone. So at last, we will be going to look at residual risks. After applying all this kind of risk planning, the risk that is still there after having mitigation plan and all those things, the risks which are still left comes under residual risks. Okay. So thank you for your attention. I hope you like this video. Do comment that what video should I make next, and I will be making more videos on GRC. Thank you for your time, and please subscribe my channel. Bye.